So I'll just share my screen and then we'll get started. So firstly, thank you everyone for taking the time out and attending this session. This is something that is really close to my heart. I've been in executive compensation and executive remuneration for a long time. I have advised senior stakeholders, boards, remuneration committees, CEOs, CHROs on various matters in relation to executive compensation. I have worked across the globe, so I've worked on NASDAQ listed, FTSE listed, Asian listed private organizations, large scale startups, scale ups, and predominantly focusing on the executive compensation area. So I've advised on how to design, structure executive pay, both from a quantum and a structure perspective. Essentially, what I wanted to do was to take you all through some of the best practices that I have come up with. This is not a one-off session by any means. This is a session that I plan to run once every fortnight over the next 5 or 6 fortnights. So essentially over a 1.5 to 2 month period. I will be getting into a lot more detail as we progress through this session, but today it's meant to be just an introduction to what I have experienced in executive compensation, some of the challenges that come up, how do you address this, what are some of the learnings, broader learnings that I have taken from
Can I request all the participants to be on mute?
For tuning into this workshop.
Rajat, I think you're on. Yeah, thank you. Thank you so much. Sorry.
Okay.
Yeah.
No, that's all right. Sorry, guys. But anyway, as I was saying, so I've dealt with various kinds of executive compensation matters. I wish to discuss some of them today with you. I will not get into the details of how you can actually address them, but I'll raise some questions. Hopefully you can take back when you get back to your work and see how some of these questions or some of these matters are relevant to you, how some of these questions may be addressed, and what happens elsewhere. But as I said, because today is just an introduction, it's not going to go into the detail. We will be covering this every fortnight, and I'll be keen as always for your feedback and anything that you want me to cover in particular. Just to set the scene, I have been trusted advisor for the board for a long, long time. So I have worked with boards and compensation committees across various sectors, across various size organizations, various ownership structures. And what you see in front of you are kind of the main questions I often hear in executive pay. To put some of these questions in perspective, how does the executive pay arrangement reflect changing business model, operating model, right? I mean, I'm working with clients right now where they are relatively small, but they're looking for massive, aggressive expansion. What does that mean from executive pay? What kind of talent do we need to go for? How much should we be paying? What about executives having enough skin in the game? Are our executives incentivized to work for the shareholders? At what stage do we know that the executives are going to work in the best interest of the shareholders?
Indradeep, sorry to interrupt. Could you please go on the presentation mode?
Oh, yeah. Sure.
Yeah. Thank you.
Yeah, is this better? Okay.
Yeah.
So and then some other questions like what happened during COVID or any of the major macroeconomic or societal or sectoral challenges, right? So our incentives are significantly underwater. How do we address this? We do not have enough cash. How do we build an incentive program? So the CEO is retiring. How do I ensure that the CEO has proper succession plans in place? What about new regulations that are coming in? How is that going to impact executive pay? So there are all these macroeconomic, microeconomic, sectoral influences that play a part in executive pay. I often tell my clients that executive pay is not just a matter of looking at salary surveys. It's not just a matter of looking at some independent research. It's often a very strong alignment, internal as well as external. Internal from an internal relativity perspective, pay for performance perspective, and external as in what your talent market is paying. So when we think about executive pay, I strongly urge you all to have an open canvas. This is probably as strategic as it gets from a compensation perspective. This is as relevant and important because this sets, or this should set, the compensation program for the rest of the organization. Anybody who has been working in compensation for any period of time, how much you pay, where you position in the market, what you constitute to be the relevant data point, how you look at hot jobs, all of these things are coming in from the executive level. So you basically need to be aware of what's happening at the executive level. What are the pay principles? What are the pay philosophies? What are the frameworks that are being implemented at the executive level so that that can then be cascaded down to the rest of the organization? So all I wanted to focus or highlight at this point is that there are various angles, as you can see, which derive you to start focusing on executive pay as a mechanism. Executive pay, if anything, is a lever. Executive pay is an opportunity for you to explore the unknown, is to start putting some framework around organization size, organization sector, organization complexity, and you put it all together, and ultimately that creates or provides the frame of reference within which executive pay is determined. So when we talk about executive pay, or when we're talking about how we address executive pay, remember there are many stakeholders in this process. There's the board, for obvious reasons. There's a compensation committee. There are the executives, and then there's the shareholders. A properly designed executive pay takes into account all these four pieces, and often these four pieces are moving pieces, right? The board obviously wants to incentivize for performance. The executives want as much money as they can. The shareholders want good value for their money. The compensation committee, from proper delegation from the board, is trying to make sure that all of these moving pieces fit into the jigsaw puzzle. So please bear that in mind, that this is as strategic as it can get, and part of our executive pay consulting or executive pay professionals, we need to manage all these various stakeholders. When we talk about executive pay benchmarking, there's historically what happens and what I consider to be best practice. So there's many different ways in which people do executive pay. And as you can see on the left, you have the various roles within the organization. So you have CEO, you then have key management personnel. These are the people who are responsible for your strategic delivery and alignment to your strategy. And then you have non-KMP executives. KMPs are also known as nominated executive positions or officers at various parts of the world. But essentially, these are the people who assist the CEO in the delivery of the business objectives, and they are the ones who are ultimately held accountable in front of the shareholders, among the rest of the executive team, but predominantly them. I think somewhat, yeah, perfect. And then there's the next level down. So the CEO minus 2. So CEO minus 1 being the executive level, broken down into KMP and non-KMP. Then you have CEO minus 2, then you have CEO minus 3. Then you start getting into the workforce, the broader workforce, right? Standard approach is a position matching approach when you look at the top of the organization, and generally a position sizing approach. I have seen organizations and I've worked with organizations where position sizing is used as a construct at the top end of town, as in for the executives, and for various reasons there are challenges around that. Because position sizing or job evaluation has been predominantly designed for workforce. Job evaluations have not been designed to take into account executives. If you work with a job evaluation at that executive level, then you need to be careful that you would be working with a job evaluation system that is specifically built for the executives. So moving further on, if you are going to apply a position mapping, then you do need to look into what kind of peer group am I looking at, right? Because you keep hearing that we pay the CEO at the 50th percentile of the market. We pay the CFO at the 75th percentile of the market. Well, the first question is, what is your market? Unless you define what your market is, then making a statement around paying at the median of the market does not make sense, right? So when we talk about market, when I talk about market, particularly at the executive level, I am talking about your talent market. I'm talking about where do you lose talent to, where do you get talent from? Let's assume for this moment that access to data is not a problem. Let's assume you have access to all the data. Even then, we need to make sure that the methodology makes sense. You need to make sure that our approach is robust and defensible. So I would urge you again to have a think about how position matching works at that executive level. Then think about what your talent market is. When you're defining a talent market, is it a matter of listing out companies, or is it a matter of listing out type of companies? And they're two different things. So companies would be the names of companies that you're looking for from a talent period. Whereas the type of companies would be best based on various filters. Are we looking at if it's a listed company, market cap? If it's an unlisted company, enterprise value? What about revenue? What about sales? What about net profit? Which one of these filters make most sense for us? If you go back to first principle and you think about that, the filter that makes most sense for us is the filter that the executives are predominantly accountable for in managing. So as an example, if you think about retail sector or you think about consumer discretionary kind of sector, what they're managing is more like a gross profit margin. They're not necessarily managing the revenue, right? Because the sell price it's determined by a different group. Whereas if you think about banks, are they managing assets or are they managing revenue? So these are questions that you need to think through and you need to answer as you look at addressing how to determine executive pay. If you keep moving to the right, and this is where organizations, as they get more sophisticated, they move further and further down, they think about it's not just typical size that determines your peer group. There are other factors like what about listed versus unlisted versus private companies, right? What about various sectors? So do you need talent to come in from your sector or can your executive come in from another sector? What about adjacent sectors? What about completely diametrically opposite sectors? What about sectors that play on different areas within that value chain? When you're then thinking about organization sizing, because then you've got to remember that when you're looking at executive talent and how executive talent moves within organizations, you can most certainly have the CEO of a fairly small organization. And the key here is defining what fairly small means. But you could definitely have the CEO of a fairly small organization step up and become your CFO. Or contrary, your CEO could step up and become the CFO of a much larger organization. So there's definitely talent migration that happens. But do you understand how your sector operates? Do you understand how executive talents move? Do you understand what the transferable skills are, what the adjacent sectors are? Because all of them would form part of your talent peer group. And without understanding talent peer group, you do not know what your market is. So again, take a step when you are looking at utilizing salary surveys. I've worked with salary survey, both ends of the spectrum. I've worked as a client, I've worked as a customer. When you think about salary surveys, think about the veracity of the data. Think about how is the salary survey being constructed? Is it being submitted by a REM analyst? And if that's the case, do you expect them to have enough information about executive pay, about enough information about contracts? Are they being truthful? So you start opening up a can of worms, right? And ultimately what that leads to is for you to start questioning, is a salary survey the best way to go? And if it's not, then what other ways do we have? Where else can we get data from? But that's where people go, they miss a step because they go straight to the data. My point is, before you go to the data, have a think about what your talent market is. Let's assume you've got all the data. What's your ideal talent market? And then the last part of this executive pay benchmarking is having a dedicated job evaluation framework which works for executives. If you think about all the relevant frameworks, right? Job evaluation, whether that's a Hay Point factor, IPE job evaluation, Aon factor, Towers-Watson factor, they are all predominantly built for the workforce, which is exactly why you'll start struggling a little bit as you start utilizing that for the executive roles. Can you use it? Of course you can. But does it provide enough differentiation? And if it doesn't, then you've got to start thinking about what are the factors that differentiate an executive role. If you think about it, you'll realize that there are factors like board relationships, there are factors like shareholder management, there are factors like complexity of the team, not just the number of team, but complexity of the team that they're managing. Think about it. A chief operating officer, yeah? Chief operating officer is never the same in two different companies. How do you identify which chief operating officer role to look at? Because in a salary survey, there is only one chief operating officer. What about a chief financial officer? Sometimes strategy reports to it, sometimes IT reports to it, sometimes payroll reports to it, sometimes mergers and acquisitions report to it, sometimes risk reports to it. So you can see the complexity that comes in with executive pay, right? And this is particularly relevant for executive pay because the supply and demand at this executive level is completely different from the workforce. You're looking for business analysts, project managers, IT managers, finance managers. There's a lot of people that you're looking for. So you can safely use salary survey data because the power of large numbers or the law of large numbers gives you protection. you don't really need to get very specific with the data and an understanding of the role. However, as you keep moving further up, every organization is designed differently. If they wouldn't be designed differently, then you wouldn't have sustainable competitive advantage. So for an organization to think about how they design their executive team, which forms a big part of their competitive advantage, you would need to take that into account. You would need to think about how does this play within the broader context of the sector, right? So again, as I said, my intent over the next few weeks is to open the lid a little bit and give you a view of some of the toolkits that we use when we solve these kind of tough, critical questions. But for today, it's not to give you any answers, but just to get you thinking, just to start you to start thinking. Because trust me, over the next 5 years, India is going to undergo a massive change in corporate governance. What that means is there's going to be, you can already see say on pay becoming relevant. You can already see that in the US, you now need to disclose pay ranges. That's going to start becoming more common. That's going to include more disclosure in the REM reports. That's going to mean there's going to be more scrutiny on the board, like what happens in Australia, and that happens in a lot of Western developed countries. By the way, I'm in Australia, so that's why you'll sometimes hear the context of Australia. But I work with clients across the world, so I'm not just limited by what I've seen in the Australian market. But if you think about what happens elsewhere in the developed economies, you would see that the directors, there's the company presents the shareholders the remuneration report, which Indian listed companies are also required to present. There's certain disclosure requirement that you must have within that remuneration report, which means you have to disclose opportunity of pay, fixed pay, any additional benefits, any leaves, all of that. Once you present that to the shareholders actually have an opportunity to say, I'm not going to vote for this. I don't like what you've got. My share price has gone down. I haven't received any dividend. My total shareholder return is fairly low. Your pay for performance lens is off the charts, and I'm not going to vote for that. So that's strike one when that happens. The next year, the company comes in and presents it again. That's strike two. If the shareholders, there's a percent of shareholders, and that slightly varies among countries, but there's a percent of shareholders who can vote no. If that happens, that's two strikes. The moment there's a two strike, then the board stands for re-election. So you can understand anybody who's trying to get into board directorship, non-executive directors, independent directors, their career is on the line because they are up for re-election. So getting the executive pay right, if you haven't been working on that yet at your work, this is coming. This is around the corner. So we have to think more critically as a profession, what does executive pay actually mean? You can't rely on salary surveys aimlessly. You cannot rely on job evaluations that are not custom built. You cannot rely upon general market. You cannot rely upon broader market forces. You have to adopt a more strategic lens when you're thinking about executive pay, and you have to think about how each of these moving pieces contribute to a broader picture. Senior stakeholder management becomes really critical. Board relationships become really critical. Defending an executive pay arrangement becomes really critical. So again, as I said, please look at all this. This is meant to get you start thinking. This is not giving you the answers. We'll explore some of this in more detail as we progress. One of the things that I really like to talk about when I'm talking about executive pay, particularly executive pay, is pay for performance. I am a big fan of pay for performance because you keep hearing that the CEO pay is, 5,000 times an average pay. And there are companies where this happens. The CEO pay is 2,500. The CEO pay is 200 times the average pay. But I am a believer that that's a very broad, generic statement. You can't really make that statement without having some context behind it. If there's an organization that's undergoing massive transformation, if there's an organization that's looking for strong mergers and acquisitions, or for that matter, organic growth, if there's an organization that was listed, no longer listed, is going to be listed again, you need a certain kind of experience. You need a certain kind of credibility within the market for the market to buy into the CEO's vision, into the CEO's leadership. For that to happen, you need to adopt a pay for performance lens. You can't just look at pay in isolation. You can't just say that getting paid, and I'm going to use dollar as an example, but you can convert it into rupees, or if there's another geography you're watching this from. But you can't say that somebody getting paid $1 million is getting paid too much. That's no longer the case, because somebody who's getting paid $1 million, inherently has a lot of other things that they need to take into account. For example, transformation, growth, executive turnover, sector redefinition, ownership structure change, not to mention the high aggressive growth path, the high aggressive trajectory, profit, EBITDA growth that they are on. So you've got to take all of that into account. And that's predominantly what executive pay is. Executive pay is basically working out a lens by which you can assess the performance of an individual executive and determine the pay framework going forward. So a very simple framework that I use is what you see in front. As we do more incentive designs, I will be opening up this framework. But I believe that at the beginning is the goal. What is the organization trying to do? The strategy supports the goal. How would the goal be achieved? And then you come into, okay, how do we measure this? It's great. We've got 5 strategic initiatives. How do we measure the strategic initiatives? How do we make sure that each of the initiatives is being followed on and the executive team and the management team are being aligned and the KPIs and the measures are being cascaded properly? So that's where the measures become really important. And in order to measure the measures, you then have a range of corporate processes, all the way from strategic planning, which happens within the CEO, CFO, CHRO level, all the way up to HR management, incentives, and talent design. But what that measure ultimately leads to is compensation strategy. That's what drives your pay strategy. So essentially, the 3 main questions we're trying to answer is what do we pay for and why, right? So what are we paying people to do? What are we expecting executives to turn up? And this can work for non-executives as well, but because our focus is more executives, let's just talk about that. What are the goals? How do they translate into strategies? How do we make sure that the strategic initiatives are being followed? What are we paying for? The second thing, how do we pay? Is it more fixed, variable? Is it more cash, equity? And third one, how much do we pay? And again, you've got pay positioning, and that comes with a peer group definition. Let's look at what the peer group is. So if you're doing executive compensation without a peer group, step 1 is wrong. Your first step is peer group definition. We need to work out what peer group we're looking at. Yeah, but these are the 3 fundamental questions that we are trying to get to the bottom of when we are designing a compensation strategy for the executives. It could also work, as I said, for the non-executives, but this is predominantly focused for the executives. Once we know the answer to all of these, then we know the target setting, right? So again, another common question that I get asked is, we can't reduce the opportunity of the CEO. The CEO was on 30% STI, meaning STI was 30% of your fixed salary. We don't want to reduce that. What can we do? Well, make it harder. If you can't reduce, it's all a jigsaw puzzle, right? It all needs to work together. If you can't reduce somebody's STI opportunity, what you can do correspondingly is increase the performance hurdles. That's where the target setting comes in. That's where the alignment of performance with pay comes in. So again, we'll be talking about a lot of these as we keep going through these sessions, but just thought you should be aware of how compensation strategy is determined for the executives, because these are the 3 main questions we're trying to answer. How much, how, and what do we pay for? Okay, so this is a classic example of a pay for performance that I wanted to share with you. So when we get called in for clients and they say, look, we really need to work out how much to pay the CEO. We're not really sure. We look at the market and this is what's happening. Can you help us defend this with the shareholders, right? And this is all across the globe. So we start with some kind of a format like this, which on the horizontal axis, you see it's a 3-year TSR growth. I'm sure all of you know what TSR is, total shareholder return. And on the vertical axis is the CEO total pay. So what we do, obviously, this has a lot of companies within that, but this would be looking at your competitive landscape. So we would say, okay, who are your top 5 competitors? Let's have a look at their total pay. Let's have a look at their 3-year TSR growth. And when we are looking at all of this, we're trying to work out the top left quadrant, which is the pink quadrant, and the bottom right quadrant, which is the blue quadrant. So where do you think the CEO should be? Obviously, we want the better value CEOs, right? So if companies have had a significant 3-year TSR growth and the CEO total pay isn't as high, then you say that you've got a really high value CEO. So this is, again, another constant example of how you've got to start thinking about all of these various moving pieces as you start working through a pay for performance framework, which is ultimately what you need. Every organization needs to have a robust, defensible pay for performance framework. We need to work out what performance are we measuring. We need to work out how we are paying, and we need to work out what is the value that the CEO is providing. So as you see, there's another sort of pay for performance dashboard that we often use. We can keep talking about that, but there are many things we look at. The pay mix, there's STI, LTI, what is the total pay, what is the fixed pay? And then we also look at what we call, and that's the reason why I got this up, there's two key parts to this. One is a talent peer group. Where do you lose talent to? Where do you get talent from? And then the other one is a performance peer group. So remember, when you're measuring performance, then you're looking at a performance peer group. You're no longer looking at a talent peer group, because essentially what you're trying to do is you're trying to say that if you're a listed organization, then for the shareholder to invest $1 into your company, they're actually not investing anywhere else. So that $1 has an opportunity cost. So you need to basically understand which companies have an equal probability of an investment by the same person that's investing in you. So what's your investor profile? What's the type of shares that people buy? Every organization has institutional investors. Every organization has large-scale investors. But you might be partly owned by private equity. You might be partly owned by large mutual funds. But depending on your ownership structure, where would they most likely be investing money? You do the analysis and you work out, okay, against that peer group, my CEO needs to perform, right? So you see how different peer groups start coming into the equation as well. We'll talk a little bit more about this when we get to that point, but ultimately, all we're trying to work out is talent peer group in determining salary, performance peer group in determining incentives, because that's what it is. Incentives are pay for performance. You go and perform, you get a certain incentive. When you are setting the KPIs, again, you've got to be really careful that the KPIs are actually a stretch KPI. When you're setting a KPI for the executive team, and I can't tell you how many times I've had these conversations where I go in and I say, that's not the right KPI. Why isn't it the right KPI? Because that's what the CEO is meant to do. I was working with the CEO earlier this week, and one of the KPIs was formulating strategy. And I went to the board and I said, that's not right. Formulating strategy is the main job for a CEO. How is that a KPI? So KPI needs to be above and beyond what's there in your position description. It could be an extension of that, as in you could still have the similar sort of accountabilities, but there needs to be stretch. Just like when you're designing a sales incentive plan, you don't go out and say, you go to a salesperson, you sell $1 and I'll give you money. There's a threshold. You need to at least hit that threshold. Same concept applies for any incentive plan. Every executive gets paid a fixed salary for doing their job. We need to work out what their job is. We need to work out what's additional on top of the job. And we need to make sure that we have a framework that allows for that additional performance to be paid through cash, equity, fixed, variable, whatever. All right. Having gone through that kind of a performance framework, I just thought I'll talk to you very quickly about short-term incentive, long-term incentive, and combined incentive. And I know I'm running short of time, so I'll try and get through this a bit quicker. I will be covering all of this in really strong detail, so don't fret. Short-term incentive essentially is an annual program, generally paid by cash with some kind of a deferral. The deferral could have a cash or equity. It typically cascades and is made available to the whole of the organization or a big part of the organization, as opposed to a long-term incentive, which is generally for only a hand-selected group of the organization. KPIs are generally financial, non-financial, could be at a group level, could be at a business unit level, generally has an individual level so that there's differentiation in pay. There could be a combination of lead versus lag KPIs. In my experience, for most of the scope group level short-term incentives, about 5 group KPIs and 3 individual KPIs are enough. I normally tell organizations not to put more than 10%, not to put less than 10% weightage on any KPIs, because that's too much. You cannot have more than 3 individual KPIs because, again, remember, these 3 KPIs are above and beyond what they're doing on their day job. And the KPIs, for obvious reasons, should be smart. There's nothing really exciting about that last part, but this is how a short-term incentive is structured. The main elements are, how do you design these various KPIs that talk to one another, and how do you design these KPIs that ultimately hit the second quadrant or the second box within the triangle that we saw a few slides back, which is hitting that sort of strategic initiatives. So it starts with the strategy, starts with the value, then starts cascading down. What CEO KPIs do I need? What KPIs does the executive team need? And it has to be cascaded. So again, have a think about how these KPIs cascade down from the bottom, from the top, and how these are additive when you go up from the bottom. Long-term incentive, again, I haven't gone into any level of detail, but I just thought it's an interesting construct. And as you see more and more organizations come up, by long-term incentive, I'm purely talking about having some kind of a performance testing on it. I'm not talking about retention plans. I'm not talking about ESOP plans. I'm not talking about employee share purchase plans. I'm not talking about grant of options. I'm just talking about a long-term incentive plan, which basically has a performance element to it. Normally, long-term incentive plans are over a 3-year period. It used to be 5 years, then it was deemed way too long, then it was reduced, and then further reduced till it got to a 3-year period, and it's rolling. So every year you have a new plan. Every year you have a new plan. A mega grant, on the other hand, is a longer period grant. So there's only one grant over that entire period of time and no subsequent grants. There's obviously pros and cons, as you can understand, between a rolling annual grant and a mega grant. The benefit is that the mega grant allows everybody to focus on one. By everybody, I mean all the participants, and the participants are generally the executive team. So all the executives to focus on one common goal, so they don't have to worry about what happens next year. The problem, obviously, is what happens to the executives that join the company mid-year, right? So if it's a 3-year plan, what happens at the end of the first year if you have another executive join? So these are obviously questions and challenges that you would need to work through, and you would need to think through as you are designing long-term incentive. This is just one out of at least 10 components. We'll be covering all of them as we go through these kind of conversations. But I just thought this is the most interesting one. And this is something that you can use straight away. So when you go back, have a think about your organization. Is there a major transformation happening? Can I design an incentive plan that basically gets the top end? So CEO -1, maybe CEO -2, but a hand-selected group, and get them into a room and say, okay, let's lock you guys up. Your job is to go and hit these goals in a 3-year period. What can we do to incentivize you? Forget about everything else. Yes, you have a short-term incentive, no more long-term incentive, no more distractions. Just focus on this. And the targets are transformation-based, so strategic initiatives. Okay, one new kind of incentive plan that's coming up has been around for about 10 years, but becoming more and more relevant, is a combined incentive plan. So essentially what a combined incentive plan does is that it combines, as the name suggests, a short-term incentive and a long-term incentive plan. They get them together and they say that rather than having two different incentive plans, how about you have one incentive plan, which is based on your short-term incentive, and then depending on how you perform in that one plan, the long-term component is a function of that short-term performance. So if you had, let's say, 20% STI, 20% LTI, you combine the two. There are methods. It's not as simple as combining, but just for the simplicity, let's say you combine the two, you get 40% as an opportunity, and you say out of that 40%, first year scorecard, let's see how much you get. 50% of that is deferred for 3 years, and that deferral could be partly participation based, as in like service condition, and partly performance tested. So the benefit with that is you don't have to keep setting and resetting various goals, particularly when you don't know what's going to happen in the next 3 years. And this also allows people to get equity earlier on, because they don't have to wait for 3 years to get the long-term incentive. They get that at the end of the first year. They just have to defer and hold it. Now, some of the conditions that could be applied on the deferral or after the deferral is like a holding lock, which basically says that let's just hold on to this. You cannot sell it for a year after you've received it. So that kind of starts slowly replicating some of the features of a long-term incentive, and we'll cover the combined incentive more. But again, I just wanted you to have a think about, is the traditional incentive plan working? Are you hearing the executives complain that there's no way I can hit the long-term plans? It's so hard to set. It's like a lottery to me. The moment you start hearing about some of this, or maybe you're hearing the board say that we want executives to have skin in the game earlier. We want them to own equity. Think combined incentive plan. I'm not saying that's the right answer, but that's a way by which you can start thinking about, well, maybe combined incentive plan is the right way to go about. because with a combined incentive plan, you have the opportunity to get the benefits of both STI and LTI without keeping them separate. Now, part of what I'm presenting today is obviously expecting that there's a level of understanding with all of this. It's all right if you don't, because this is not meant to be an educational session. It's more meant to be an awareness session. When we do go through the long-term incentive sessions, I will get into this in more detail and I'll break it down just so that we can have more relevant conversations. But today, just have a look at this and see whether this makes sense to you or not. The last thing that I wanted to talk about was corporate governance standards. So basically, this is becoming quite important within the world for obvious reasons. And you will see that there's more and more of these standards, with or without your awareness, that will start seeping into your organization, right? So this is not necessarily for a listed company. This is not necessarily for an international subsidiary, but this is basically how does the board interact with management, and how does executive pay play a part in that? So first, initially you do your market benchmarking. Generally, it's an annual process or once every 2-year process, but you need to design everything that we discussed. So what's your talent peer group? What's your pay for performance framework? You build that out. You then, once you've designed your basic incentive, basic executive pay, you present that to the board, and you would, as management, we would need to suggest or recommend what kind of weightage applies, what's the split between financial, non-financial measures, lead, lag indicators. The board then goes, okay, that's fine. We're happy with the structure. The board approves that. Then we need to prepare the targets for each of the measures. So the board will approve the scorecard, but the targets, that underlying targets, need to be approved by the board. So we first need to propose and design those targets. Those targets typically should be coming off your budget that the board has signed off. Then we would apply a range on that. So we would say, okay, there's a threshold, there's a target, there's a maximum. What ratio do we apply? So generally, organizations apply a 90% of the target as a threshold and about 120% or 130% of the target as a maximum outperformance. That has a corresponding payout, so we need to design that. We present the final scorecard to the board along with the measures and the targets. The board approves that. That then ticks off that, okay, this is what we want the organization as a group to focus on for this year. The board, then those KPIs then get cascaded with the CEO for their individual KPIs. That is then discussed with the chair and the board. So we would, as a REM professional, we would sit down with the CHRO, with the CEO, and say, what do you want, chair of the board, the CEO to focus on? What should their KPIs be? We then take that KPIs and sit down with the CEO and say, how do you want to cascade this down? So remember, if the CEO has 3 individual KPIs, then those 3 KPIs should be shared, but there should be something that the CEO is doing on their own. There's principles of performance management, principles of calibration that are slightly different from a broad-based level that we would typically apply for executive roles. But again, that comes into account. And then once the KPIs are designed, those are covered off, those are kept, sent out and handed out as a letter, and then a template is typically shared where each executive then sits down and builds it up for the direct reports, and then that gets passed on to the broad-based reward team, which essentially ensures that the KPIs have been shared, they've been captured, they're being monitored, regular conversations are being having, and then from an executive pay perspective, particularly if you're working with executive pay, you swap back in. So you go back again to the executive team and you say, okay, right, these are your KPIs, this is what we are going to be holding you accountable for. So that's pretty much what I had. Yeah, and so these are some of the sessions that I would be discussing more on. You can read them out, the basics of fixed pay benchmarking, short-term incentive design, long-term incentive design, pay practices at various companies and how they mature and how the pay practices change. But again, there'll be more executive pay focused. And then at the end, I'll talk a little bit about sales incentive, although that's not typically executive pay, but I'll talk a little bit of that because that's still incentive design. So I put down some timings that you see in front of you. These are all tentative. These are all Friday based. Because I'm in Australia, I'm about 5.5 hours ahead of India. So we just need to work out on timings. But the team will definitely get in touch with you and let you know. Right. So that's all I had to cover. Should I stop sharing and see if there's any questions that you guys have?
Yes, Indradeep. we already have a lot of questions, so we'll try to cover as many as possible. We have a question from Priyanka. How to design the minimum threshold of equity stock assignment while hiring a new KMP SMP?
Yeah, so look, when you're designing everything, and the fact that you're asking me this question is a really interesting construct. It goes back to exactly what I was saying. This is basically a framework question. You should not be designing or looking at the minimum payout or looking at these opportunities on a case-by-case basis. We should first have a framework which says that at the CEO level, this is the entitlement. At the next level, this is the end. We should know that from before. And that's what you go in for with your negotiation. If you do go beyond that negotiation, as in you go above the point that is part of the framework, I would always recommend, is there another way that you can manage this through a one-off offering? Don't dilute, don't damage the framework. The framework is there for a particular reason. Keep the framework as is. See if you can manage this through an additional top-up, because that's how you can maintain internal relativity. Otherwise, it'll again go back out of whack.
Great. I hope, Priyanka, that helps you. We have a question from Pamela. How do we decide on the KPIs? What is the baseline apart from the peer comparison?
Look, the KPIs should never be about the peer. The KPIs are all internal measures. Basically, when you're talking about KPIs, and yes, there are repositories. There are like, I have worked in executive pay for so long. I have a repository pretty much for any role you can think of, but they're still not the KPIs that would be relevant to the role. A KPI is, as I said, if you think about the process, the first one being the goals, then the business strategy. The strategy would lead to the next part, which is the strategic initiatives or the measures. The board signs off on that, and then those measures get cascaded down. So when you're thinking about KPIs, I would not worry about KPIs external. I would worry about KPIs internal.
Great. Then we have a question from Shankar. In practice, what's the success rate for deferred compensation plans? In practical, what's the success rate for deferred compensation plans?
In practice, it's very successful because of three reasons. The first reason is when you have a deferred compensation plan, there's a retention element to it. So executives are obviously going to stay back because they've earned the money, they just need to be there. And that's what the deferral is. Typically, if you don't overcomplicate it with a performance tail to it. The second thing is when you think about a deferral, that also allows for more complex management of incentive programs like malus and clawback. So if you don't know what malus and clawback refer to, they're basically constructs that allow organization to pull back the money if there's been a material misstatement or there's been a fraudulent activity. So from an organization's perspective, that's really good. And the third thing is, particularly if the deferral program is granted in equity, then there's an opportunity for you to grow your money. So there are organizations which say that, okay, let's say you earn $100, 40% of that is deferred in shares. And just to give you the comfort, if the share price goes down in the next 1 year, you will still earn this much as a cash payout. However, if the share price goes up, then you have the benefit of that uplift.
Good. We have a question from Payal. How does the combined incentive plan impact companies' dilution?
Look, it impacts companies' dilution, but if you really think about what it's meant to deliver, the combined incentive plan it's still, the opportunity is still there. The only thing that happens is equity is granted earlier on, but you still have to hold on to that equity for the tail of that combined incentive plan. So dilution, is it more dilutionary in effect? Probably, because it's probably going to have a higher probability of vesting. But apart from that, it's less than 3-4% when you think about a traditional plan versus a combined incentive plan. And there are ways in which you can structure it so that the dilution is not felt.
Okay, this is our last question. Deferred cash plans seen as free money by stakeholders, are they recommended or do they work at all in favor of organization?
Look, I mean, as I said, even if it's a cash plan, there's a retention element to it, and then there's a malus and clawback element to it. So shareholders, as long as they understand the story, which is why I go back to the first principle that I discussed earlier on, that this is as much a matter of managing stakeholders and understanding the framework and how things move as it is a matter of providing a response. So absolutely, would they look at that and go, well, it's just a cash payout, there's no performance condition? Yes, true, but they've already earned that money. That's what a deferred cash is. So if anything, shareholders should go, yeah, that's great, because we've now got executives who are not getting the money that they've already earned. If that's what you mean by deferred cash plan. If there's anything else, then that's not really a deferred cash. Deferred cash plan means you've earned it, but you've got to wait a period to receive it.
Great. So those were the questions we had, Indradeep. Thank you so much for this wonderful session. I know that these slides were tailor-made for LEDex participants. You tapped into many areas, which I'm sure will be new for most of our participants. I think the upcoming events will be really, really helpful to all of us. To all the participants, thank you so much for tuning in and staying here for this hour of the time and making this event a successful one. We will be shortly having offline events in Bangalore in April, first week or second week. We'll definitely announce the dates very soon. The offline events will also be conducted in Mumbai and Hyderabad. So look forward for the same support which you have offered to us. Thank you so much.
Yeah,
Thank you
before
once again.
everyone.
Before logging off, Indradeep, can you just share your email ID in the chat box so that people can reach out to you directly, if as and when they require?
Yeah, sure. I'll just give you directly my LinkedIn is also there. So it's like with a name like mine, it's a bit hard to not find me. But that's my email address. You can find me on LinkedIn, Indradeep Mazumdar, or my email, indradeep.mazumdar@gmail.com.
Awesome. Awesome.
Thank
you,
you,
everybody,
Nikhil.
for attending the session.
Nice to hear you.
Yeah.
Have a good rest of the evening, and we'll talk soon. See ya. Bye-bye.
Bye.
Bye.